With me today is Richard McWhorter, is a CFP and managing partner at SRM Private Wealth with approximately $1.85 billion in assets under management.
My investment strategy, it really is individualized. So we do a lot of planning with individual clients. I have about 36 households right now.
So you're saying get rich and then stay rich. You're in the stay rich business, not in the get rich business.
100%.
And welcome everyone to another Smart Money Circle episode. I'm Adam Sarhan. With me today is Richard McWhorter, is a CFP and managing partner at SRM Private Wealth with approximately $1.85 billion in assets under management. Richard, thank you so much for taking the time and welcome to the Smart Money Circle.
Thank you, Adam, for having me.
So Richard, I always like to begin. Can you please tell us your story and how you got to where you are today?
So I started unconventionally. I was 17 years old, just graduated high school, and got an internship at, back then, Dean Witter Reynolds, and kind of worked my way up to receptionist, and then I became a sales assistant for 7 financial advisors. And in 1992, I got the opportunity to become a financial advisor and began my career.
Oh, very nice. So you started at 17, you said?
17 as an intern. Yeah.
Wow. And did you know, did you fall in love, or was it one of those situations where you just did it and just kept on doing it?
Yeah. So I didn't know what to expect. I didn't know really what I wanted to do. And over time, I just started to fall in love with the business. I learned a lot from various financial advisors over the years, and just began this process of falling in love with the way that it's done and helping people. And yeah, that's what happened.
I love that. Okay, so the whole goal of the show is to get timeless advice. So I'm going to ask you, if you don't mind, can you please share some of those lessons that you've learned along the way?
Yeah, the biggest lesson for me has been, just to continue my learning. I will tell you that the process over the years, there's been several times, especially in the early years of my business, where you don't know if you're going to make it. You don't know how you're going to survive. You don't even know if you really want to do this anymore. It's a lot of work. It's a long hours. And what happened was I remember vividly in 1999, I was kind of ready to get out and find something else to do, and didn't quite know which way I was going to go with that. And a manager at the time, I sat down with him for lunch, and we talked about, various things that I could do. And he said, just give it a little bit more time. And at that time, I started to revamp my career, and I started to study and learn and about things that I didn't know very well. And if you remember 1999, we're in the height of the markets and at that time. And I was doing primarily fixed income at that moment for several reasons. And just started to revamp who I was and how I did things. And that learning process over the last 25 years has propelled me to where we're at today.
Wow, I love that. Okay, so invest in yourself and always, never stop learning type of a thing. I like what you said too about that 1 second rule. I've all been there, and I actually have that in the book too, where it's like 1 second. If you just hold on for a little bit longer, one proverbial second, it'll go your favor. But so many people just give up.
Yeah, and it's one of those things that you really, once again, we don't know how things are going to work out ever. So, giving it that 1 second, and then learning to adapt. We've had to adapt, and our industry has changed so much over the last 32 years that learning how to adapt to these changes. And right now, how are we going to adapt to the next phase? So you just keeping yourself open and as I said, wanting to learn just continues to propel it. So
yeah, it's priceless. Okay, let's talk about your investment strategy. Please let us know anything you want to go.
Yeah, my investment strategy, it really is individualized. So we do a lot of planning with individual clients. We have about 36 households right now. And each one of those we become, we get to know them pretty well. A lot of clients will divulge information right off, and there's other clients that will take time to get the information necessary to create their investment portfolios. A lot of the times people want everything to go up in value and have the highest amount of income from their fixed income and all of these wonderful things. And when it doesn't go that way, it becomes a different being for them. So a lot of that is learned over a process, and they learn about themselves and I learn about them, and we can, invest around their inherent risks that they have within their businesses or other assets. So it's very individualized. But primarily the people that we get to invest or that hire us, I explain myself to new people all the time as being a singles and doubles hitter all day long. I am not a home run hitter. I am not that guy that's going to be trading stocks, and I'm just not that. A client of mine, and still a client today, in 1994, I walked into his office and he sat me down, and I'm a 24-year-old kid, and he said to me, don't come in here and tell me you're going to make me rich. I am rich. Just don't mess it up. Right. And that really helped me understand that, there's a lot of people out there that are trying to grow their wealth at the highest return, and are willing to take on that risk. There's a lot of people, though, that just want to maintain and not lose and get a decent rate of return, and potentially compound their interest, and they're not looking to make a killing. They've already made that killing, and that's the type of clientele that we primarily work with. But so if people are looking for a home run hitter, I'm just not. A home run for me is a complete accident.
That makes perfect sense. So you're saying there's two jobs: is get rich and then stay rich. You're in the stay rich business, not in the get rich business.
100%. Yeah. The type of clientele that is going to go primarily into fixed income, those guys are not looking to make a killing. They've already done it. So.
No, it makes perfect sense. So you do an asset allocation between equities and bonds, or are you primarily fixed income, or how do you allocate?
Each client's different. Each client is completely different. I will tell you that we're about 74% in fixed income currently and 26% in equities. And a lot of the private equity and any alts that people are doing it outside of us. They can go direct primarily. Most of the people that we deal with are real estate guys or have sold a private business. We've been very fortunate to get involved in some sports teams. We've been very involved in the selling of one sports team, which was a wonderful event to be a part of. And, but besides that, it really is pretty much a individualized portfolio that we have designed specifically for each person. So.
I love that. Makes sense. Let's talk about the next subject is risk management. How do you handle risk? What are some mistakes you see people make with respect to risk management?
Yeah. Most of the people that I think invest, and a lot of financial advisors, and I've been in this business a long time, so there's a lot of financial advisors I've had these conversations with, and examples would be that they would take full positions in an equity right off, thinking that they know that the stock's going to go up, or they're playing the momentum of the stock and trying to trade versus invest, and which are two different beings completely. So the uh, the movement of equities is almost impossible to predict. I love all these guys that come out and try and predict which way everything's going to go, and there's just too many variables for all of that. So, from my perspective, and so we utilize dollar cost averaging quite a bit, dollar cost averaging into equities, and then as far as fixed income, we're basically doing the same thing, especially now. Which way are rates going to go? What's going to happen with inflation going forward? Is there going to be tariffs? There's a lot of potential changes that are going to occur or that may occur, and so we have to be prepared for that. So, in general, to answer your question directly, is that we utilize a lot of hedging. We utilize a lot of non-correlated assets. I'll give you a quick example. If you look at the utility sector prior to AI and all that stuff, the utilities, if you look at an investment like XLU, which is the utility ETF.
Yeah.
If you look at XLU, that had a 0.48 correlation to the market at the time, and was paying a 4.8% dividend. So I'm not recommending XLU, but what I am saying to you is that if you look at something like that, you can see that it's pretty much non-correlated to the S&P 500. It pays a nice dividend in the interim period, and you can calculate things based on those types of investments. So utilizing those types of hedges, utilizing dollar cost averaging, compounding of interest, it's really a nuts and bolts type of practice, just utilizing old theories on investing. So
No, that makes sense. So the advice for the audience would be, from a risk standpoint, would be not to get too cute. I had thought the other day, somebody said, "Oh, about day trading," and your point about predicting stocks and every tick and going up and down, all that crazy stuff. It's like, I don't know any billionaire day traders, but we know lots of billionaire investors. And that's also to your point about difference between trading and short-term, 1 minute charts and all that not crazy stuff, where it's just not the game that you play. No, it makes perfect sense.
That's exactly right. And a lot of people are, listen, I look at some of my clients who are investors in real estate, and those people are, they've held on to their property forever. They don't buy and sell property. They're not, and those are the ones with real net worth,
Right.
from what I've seen.
Right.
I'm sure there's people out there that have done very well buying and selling things. But these guys have created real generational wealth because they've been able to hold on to really good properties over a long period of time. And if you look at stocks or bonds have a maturity, so that's not as fair. But if you look at stocks, for example, and you buy really good companies over a long period of time, and as long as something structurally doesn't change, I think that's the way to go for me.
Good. That makes perfect sense. So let's talk about timeless lessons. What are some timeless lessons, Richard, that you learned along the way that you'd like to share with the audience?
Yeah, there's so many of those. But just to kind of focus on a few of them is that, a lot of, um, for me, understanding that these momentum times, when you look at 98, 99, if you look at 2006, 2007, you look at these various times, and whether or not we're in that time today, that will be soon to be told. But a lot of those things is, not to get wrapped up in changing your philosophies based upon what we think are this time is different events. A lot of the time, this time is different is not different. It's just delayed for the reactions that take place over time. So my point in that is that I think that a lot of people have tried to jump on the bandwagons over a period of time and then really get hurt when they're left holding the bag at the end of the day. And we try and stay away from that. The markets have done great over the last couple of years. I'm really not interested in the risk level that I think is in the markets today with the high multiples and rising interest rates currently on the longer end. And so you have to really kind of get yourself out of that day to day, getting wrapped up in what everyone else is doing.
Mhm.
One of the things that happens with me quite often is I get a lot of phone calls from wholesalers, and they're trying to come into your office, or nowadays they call you
Yeah.
to you know tell you about their great new products and all this, and they tell me that all these other financial advisors who they think I know or may know or are doing these types of investments. And um, the fact of the matter is that when I hear that, that means all the crowd is all going one way. And so I try and stay away from going just with the crowd. I spend a lot of time researching uh, the domestic macroeconomy. Not to say that I have, that I know what's going to happen next, but it does give me a true understanding of, or it gives me a better understanding of what is happening underlying. Um, so just stick to your guns is my point. So at the end of the day, that's one of the big lessons for me, and not to just kind of go with the crowd. Um, so
No, it makes perfect sense. How about the other side of that? Instead of timeless lessons, what about some timeless mistakes besides day
mm,
trading and being too overconsumed or caught up in the news du jour? What
mm.
are other timeless mistakes that you'd like to share with the audience?
FOMO is the big one. FOMO is a
Yeah.
mistake, right? It's basically trying to make sure that we continue to not get, once again, the fear of missing out for a lot of people, and allowing clients to get involved in that momentum. FOMO is a big mistake that I've made over the years. Um, or I second guess the numbers that I run, and I run valuations on stocks all the time. And once again, not to say that they're right, we create a range where that stock should trade, and all of a sudden it goes up, and you're like, I missed out. Maybe I should buy it now, even though it's not a good value. And the Nvidias of the world those are all individual stocks that there's been a lot of conversation about over the years, those types of stocks. Um, but we forget that a number of years ago that stock was battered, and they thought that thing wasn't going to survive for a bit, and now it's the darling of Wall Street. So yeah, but FOMO I think is the big one, because a lot of people get caught up in that, especially clients.
Yeah, you bring up two good points there. So valuation and FOMO. So first off, how do you avoid FOMO?
I stick to my numbers. I'm a data guy, so everything comes down to the data. We run. Every month I get very excited about running the unemployment figures and charting it the way that I do, and running the inflation numbers, and that really excites me. And um, I'm not the fun guy at the bar that's talking about how inflation is calculated and things like that. But I think in general, I have to stick to my numbers. And I got a phone call from a client today that was basically asking about a couple stocks that I think are wildly overvalued, and my opinion on those things. And I had to give him my personal opinion. The other side of that, though, is that, and one thing I have learned is that maybe it's not bad to take a partial position in some of these things, and knowing that if it does go down, that I can add to that position. Um, and if it goes up, well, at least I have something. Um, so there are things like that may make sense for some that are willing to take on that risk, even though that things may be overvalued, because bottom line is that things continue to could get more overvalued over time. So
Mhm.
it's, and for people to miss out on stuff like that is sometimes a bigger deal. And there's an upset that comes because of that. So yeah.
Yeah, that makes sense. So what about the numbers? And the second point was valuation. How do
Uh-huh.
you value, like beauty is in the eye of the beholder many times. So how
Mhm.
do you run those numbers and data and valuation?
Yeah, we have so we put together uh, I get financials on companies for about 10 years. Now I'm getting so old that it's now I've got 22 years of data. I've been doing this for so long now. And so we can go back and look at, what the average multiples are that things are trading at. I input the numbers manually instead of having them downloaded. So this might sound off, but I can feel the numbers. I can see where their debt is decreasing. I can see if revenue is increasing or decreasing. I look at shares and are they decreasing the number of shares outstanding? How is their long-term liabilities? What's the return on equity? What's their, what book value and what's the average multiple to book value? What's the average multiple to, what's the price to sales? Um, and and then looking at future value, future numbers, we utilize, for example, we can go out and look at a stock and there's 10 analysts that are following it, and we use the average of those 10 analysts to give us an idea of whether or not it's what the earnings are going to look like over the next 2, 3, 4 years. And we use an average of those guys, not one over the other. Um, and so what it does is it allows us to at least start to look at what the multiple is that it's traded at historically, what the average has been, what the high multiple's been, what the low multiple's been, and we can run all those numbers. Once again, there's no exactness to it. I know a stock that, the average multiple is 18 or has been 18 over the last 25 years. It's currently trading at 42 times forward. Um,
Right.
and it never traded above 27 times, and the low is 8, right? So you look at a range like that, but now it's trading at plus 40. How do you even justify that relatively? And by the way, their revenue is declining. So,
Mhm.
those are the types of numbers that we can look at, and it gives us at least an idea or a feel about what that range is that stock should trade in based upon the future value. I'm sorry, the future earnings projections for that stock. So
No, it makes perfect sense. And then how about you said you chart or not GDP, but unemployment?
unemployment. Mhm.
Yeah. Can you speak to that a little bit?
Yeah, so I just created a spreadsheet many years ago, and every month when the first Friday of every month when the report comes out, I chart where jobs are being created and where they're not being created. And it's wonderful to listen to a lot of the pundits on television talking about all this stuff, and then you kind of know at least what the data is showing you. And then I know there's been a lot of talk about revisions to all of this stuff and exactness of the numbers. And the thing you have to realize with all those numbers, there is no exactness.
Right.
It takes time, and there's revisions every single year, and every month they do from the previous month they make little changes, and then every year they do a massive change, and we think that this stuff is new and it's just happening now, and the reality is it's always happening. All those changes are happening. So you chart it out, and as I said, I have my spreadsheet, and it's been going on for a long time, and I can tell you where jobs are being created and where they're not, and that's interesting to me. I don't really get into any of the other more micro areas that they have available on that, but I do like um, at least understanding. It's more understanding than anything else. And same thing with inflation. It's understanding how inflation is calculated and where the weightings are. And people talk about um, what we see every day, which is primarily gas and food. If people look at what energy and food makes up of the inflation number, it's 21%
Mhm.
approximately. But you look at something called owner equivalent rent, and you're looking at 34% of that number, just that one number, right? It changes all the time, but primarily around 34%. So you look at these types of things, and it gives you an idea, right? I've run numbers on crime in Los Angeles County where I live, and you look at homelessness, and you look at all these things, and once again, it's never exact, um, but it does give you a feel, plus or minus whatever you want to put in there. But does give you a feel of are these situations getting worse? Are they getting better? And it takes away a lot of the rhetoric. It takes away from a lot of the rhetoric. Once again, nothing's 100% accurate,
Mhm.
but it does give you that feel for it. So
No, makes perfect sense. And then
yeah.
let's talk about individual stocks and analyzing that because I love what you said about looking at the range. You look at the 10 years of data. Can you speak a little bit more about how you decide whether or not the stock is good or not good
Mhm.
and like revenue or anything you want to go?
Sure. No, we're looking for companies that are trading within the range on the lower side of the multiples and that we've come up with. And I want to see increasing revenue, and I want to see lowering debt, and I want to see buyback of shares, and I want to see a bunch of different things. I want to see, return on equity of 12% or better. All these types of things we're looking at. And once again, it's, we create a range, right? So, if I'm looking at a stock and let's say the range is 100 to 150 and the stock's trading at 120, I might take a small position. If it goes to 110, I'm going to take a more position. If it goes to 100, I'll take a bigger position. And I'm going to dollar cost average my way into it, but it's because it's on the lower side of where I want to buy it. There could be some other macro themes to it, where look at the infrastructure for AI. And if you're looking at the infrastructure for AI, there's companies out there that are behind the scenes, not necessarily AI type companies that are benefiting from this whole potential revolution, right? So if I'm looking for those, then I'm once again I'm trying to buy them on the lower side of their revenue. I'm sorry, the lower side of their multiple, and looking at their future value and what the growth rates are for the future. And there's a whole mixture of information, and then you kind of have to go, all right, well, I, the one thing that always comes to me is that I don't know, right? And that's okay, right? A lot of people want to know or want to make predictions and all this stuff. And I'm okay with just the idea of going, I don't know exactly. I'm not 100%, right? And I don't think anyone can be. So my point is that um, just like I said, if it's trading on the lower side of the multiple, it fits into what I'm looking for, all of these types of things, then I'm going to start acquiring it a little bit at a time. And I'll take a position. If it goes down, I want to buy some more. And I always tell my clients, it's going to sound really wrong, but after I buy a stock, I want that stock to go down so I can accumulate at lower prices and dollar cost average in at lower prices. If it goes up from there, then I have at least a position in it. But if it goes down, we're good. That's what I want. Um, and the only reason I take that position is just in case it goes up and I miss it. So
No, it makes sense. And then from a risk standpoint, when it goes down, you dollar cost average on the way down. How do you know when you're wrong and you have to sell it?
yeah, I mean, if they start to revise earnings projections, if something structurally is changing, if something else happens, yeah, then at some point you're going to have to, there could be mistakes that occur, right? And there's things that change over time, and all this stuff is very fluid.
Mhm.
So yeah, there's always those types of things. And by the way, when we're selling, right on the other side, when we do sell, it's the same conceptual idea. We start to dollar cost average out at the same time that because I don't know where the top is. I also don't
Right.
know where the bottom is, right? Um, I know where it should be approximately, but ultimately you're making these decisions based upon, once again, a range. So,
Understood. That makes
yeah.
sense. And then it almost like you're waiting for the thesis to be disproved, if I understand you properly, right?
Yes,
So yeah, okay.
100%.
Understood.
And,
Okay.
and you're always running the numbers, right? So those numbers are being updated all the time. Like I mentioned earlier, the 10 analysts that are following a specific stock but they're changing their numbers all the time. So when you're updating your numbers and going through that process, you're going, okay, well now it's changed, right? The outlook has changed, or something structurally has changed, and and you have to be okay with taking that. That's going to be part of this whole idea. So,
Gotcha. That makes perfect sense. Okay, final question for you, Richard. What is the
mhm.
best piece of advice you'd like to give the audience or your 30-year-old self?
Uh, patience, patience. In general, once again, the biggest thing that I see that people are making mistakes are on is FOMO. FOMO is a big area, especially right now. So I think people have to just kind of be patient. I'm being asked a lot, what's going to happen with interest rates? What's going to happen with the stock market? What's going to happen with the new administration? We need to give it a second because we don't know yet, right? Our new administration's not even in yet, and people are trying to put in their bets on what's going to happen. And all I'm saying is, I got to take it easy for a second. And so, patience for my 30-year-old self, for sure, and for people out there is just to be patient. Dollar cost average, right? Do all these things that, unless you're willing to take on the risk of, wild gyrations. I would just say that patience is the word I would leave you with.
I love it. Richard, thank you so much for taking the time. And I'll have a link to your website in the description. And hopefully we'll have you on again soon. This was fantastic.
Thank you for having me. I appreciate it.